Next is empirical evidence on semi-strong efficient market theory. Semi-strong means the public information is incorporated in the current price. Semi-strong form efficient market theory holds that the stock prices adjust rapidly all publicly available information. By using publicly available information, investors will not be able to earn above normal rates of return after considering the risk factor. To test semi-strong form of efficient market theory, a number of studies was conducted which lead to the following queries. Whether it was possible to earn on above normal rate of return after adjustment of risk using only publicly available information, how rapidly prices adjust to the public announcement with regard to earning, dividend, merger, acquisition, stock split. So how this information will be rapidly, immediately, say incorporated in the price of the security. Several studies support the semi-strong form of semi-strong form efficient market theory. Pharma, Fisher, Jensen role in their adjustment of the stock prices to the new information examined the effect of the stock split on a return of 940 stock splits in New York Stock Exchange during the period 1957 to 1959. They found that say, prior to the split, the stock earns higher return than predicted by any market model. We know that the stock split stands for so the division of one share into many. Let us say that so the stock split is of like 5 for every one share. Then in that case, say for the face value of rupees 10, 5 equity shares will be issued of face value of rupees 2. Ball and Brown, in an empirical evaluation of accounting income numbers, studied the effect of annual earning announcement. They divided the firm into two groups. First group consists of the firms whose earning increased in relation to the average corporate earning, while the second group consists of the firms whose earning decreased in relation to the average corporate earning. They found that before announcement of the earning, stock in the first group earned positive abnormal return, while stock in the second group earned negative abnormal return after the announcement of the earning. Stock in both the earned stock in both the groups earned normal return. So basically what happens at say that nobody is able to earn the super normal return. That is what's the contention that they have. There have been studies which have been empirically documented showing the following inefficiencies and abnormalities. That is anomalies. Stock price adjusts gradually, not rapidly to the announcement of unanticipated changes in the quarterly earning. So gradually that information is incorporated in the price. Small firms portfolios seemed to outperform large firms portfolio. Means the small firms have a potential, that is we can say that the small cap companies have a potential of the high increase, and with that so the price of the equity share can have a like big jump, and with that the investor may be able to earn the higher return. But that is not the case with the large cap companies, because the large cap companies have already increased to a great extent. Low price earning multiple stock trend to outperform large price earning multiple stock. So the price earning ratio is indicating what is the market price of equity share for every 1 rupee of earning per share. Had the price earning ratio is maybe a result of that the prices of the security will now not increase much, but the low price earning ratio, so that price can increase much, and with that the investor may be able to earn the superior return. Monday's return is lower than the return of the other days of the week because Monday is the first day of the trading. Empirical evidence of the strong form of efficient market theory. According to the efficient market theory, all available information, may it be public, may it be private, is reflected in the stock prices. This represents extreme hypothesis. To test the theory, researchers analyzed the returns earned by certain group, namely corporate insiders, specialists on stock exchange, mutual fund managers who have access to internal information and not publicly available information. We can say that say we can check the returns of the portfolio of relatives of like Ambani family, relatives of Adani family, or the person who is there in the board, that is in directors, his like the first circle, for them the returns are analyzed, or possess the greater resource or ability to intensively analyze the information in public domain. They suggested that the corporate insiders having access to the internal information and stock exchange specialist having monopolistic exposure, because what happens that so the mutual fund managers have say in that is say have a privilege that say they can meet to the directly to the management of the company and they can know their ideas, say what they are going to do in future. So whatever this kind of information that say they are able to access, say because of the like a certain special position, this information can be used by them for the purpose of making personal gain. Earn superior rate of return after adjustment of the risk. Mutual fund managers do not on an average earn a superior rate of return. No scientific evidence has been formulated to indicate that investment performance of the professionally managed portfolios as a group has been any better than randomly selected portfolios. So the mutual fund managers who are in like the whole day in the exercise of fundamental analysis, technical analysis, and they are doing say the lot of research work, in spite of that say they are not able to earn the superior return. This was the finding of Burton Malkin in his random walk down street, New York. Challenges to the efficient market theory. Information inadequacy, limited information processing capabilities, irrational behavior, and monopolistic influence. So, because of all this, say there is a possibility to earn the superior return. That is what they want to say. Information is neither freely available nor rapidly transmitted to all participants in the stock market. This is very true. That say information is neither freely available. We can say that that limitation has overcome to a very good extent due to internet. However, it is not rapidly transported into all participants in the stock market. This is a calculated attempt by many companies to circulate misinformation. Limited information processing abilities. This is very important. Means the same information may be having such a different interpretation. Human information processing capabilities are sharply limited. According to Herbert Simon, every human organism lives in an environment which generates millions of new bits of the information every second, but bottleneck of the perpetual apparatus does not admit all then 1,000 bits per second and possibility much less. So information is generated too much, but the processing is done of very few. David Draymond maintained that under conditions of anxiety and uncertainty, with a vast interchanging information grid, the market can become a giant. So basically what happens at say all the information may not be properly processed, and that is the reason say there is a possibility of the inefficiency in the market. That is what they want to say. It is generally believed that the investors rationally will ensure a close correspondence between market prices and intrinsic value. But in practice, this is not true. J.M. Keyes argued that all sort of the consideration enter into the market valuation, which is in no way relevant to the prospective yield. Means there are a number of non-financial factors that also take into account, that are also, that is considered say in the price of the security. This is what say they say. So not only the fundamental factors, not only the management capabilities, not only the economic factors, but maybe some surprising factors may be considered or may be entering into calculation of the price of security. This was confirmed by L.C. Gupta, who found that the market evaluation process worked haphazardly, almost like a blind man firing a gun. So like this. The market seemed to function largely on hit or miss tactics rather than on the basis of the informed belief about long-term prospects of the individual enterprises. So basically this says something like this, that what happens that number of times the information or the kind of we have heard something like this, that there are certain market makers say who channelize or who show the information in such a way because of which say the investors may be carried away. So the valuation and actually intrinsic value may have a vast difference. Monopolistic influence, a market is regarded as highly competitive. No single buyer or seller is supposed to have undue influence over the prices. In practice, powerful institutions and big operators wide great influence over the market. The monopolistic power enjoyed by them diminishes the competitiveness of the market. So it may happen that a group of the buyers say may have the influence and they may take away the market in the way they want to take.